Welcome to the Commodities Institute podcast. I'm Emily Costa, and it is Tuesday, January 27th, 2026. It is a pleasure to have you with us for another deep dive into the forces shaping our world. We have a packed schedule today, and we are going to start by looking at a major shift in the metals industry before we move through the halls of power in Europe and finally settle into the frozen energy hubs of North America. We begin today with a massive move in the gold sector. The Chinese mining giant Zijin Gold has announced its intention to acquire the Canadian miner Allied Gold for approximately 5 billion Canadian dollars in cash. This is a significant development as it highlights how record-high gold prices are fueling a wave of consolidation. Large producers are currently looking to secure long-life assets and boost their output through acquisitions, rather than the long and expensive process of developing new mines from scratch. Interestingly, this deal is happening against a backdrop of mending ties between Canada and China, following preliminary agreements to ease trade barriers. For Allied Gold shareholders, this represents a premium of about 5.4% over the recent closing price, and the transaction is expected to wrap up by late April of this year. Staying with metals but moving toward the industrial side, there is historic news for the United States aluminum industry. Century Aluminum is set to take a 40% stake in a new smelter project in Oklahoma, which is being led by Emirates Global Aluminium. This is incredibly noteworthy because it represents the first primary aluminum plant to be built in the United States in nearly half a century. The planned capacity for this facility has actually been increased to 750,000 metric tons per year, which would more than double the current domestic output. With 85% of American industrial aluminum needs currently met by imports, this project is being viewed as a vital step for the automotive, aerospace, and defense sectors. Construction is slated to begin by the end of this year, with production starting toward the end of the decade. Now, let's pivot to the shifting energy landscape in Europe. On Monday, European Union countries gave their final legal approval to ban Russian gas imports by late 2027. This makes a long-standing vow legally binding. While the ban was designed to overcome opposition from countries like Hungary and Slovakia, who remain heavily reliant on Russian energy, the timeline is now set. The European Union will halt Russian liquefied natural gas imports by the end of 2026 and pipeline gas by September of 2027. This is a massive shift, considering Russia supplied over 40% of the European Union's gas before 2022. That figure has already dropped to about 13% as of last year. Companies that fail to comply with these new rules could face financial penalties of up to 3.5% of their total global annual turnover. While we are discussing emissions and power, there is some fascinating data regarding global pollutants. Researchers found that China and India actually cut their emissions from electricity generation in 2025. This is the first time in over 5 decades that emissions from these two coal giants declined simultaneously. The reason? A record-setting deployment of clean energy. This decline helped cap global growth in pollutants, effectively offsetting a significant rise in coal-fired power emissions in the United States. In the US, coal-fired power output jumped over 13% last year, driven in part by policy incentives and a slowdown in plant closures. However, the progress in Asia suggests that the clean energy transition is reaching a critical mass that can balance out surges elsewhere. Turning our attention to agriculture, the narrative is all about South American dominance. China is expected to significantly favor Brazilian soybeans in the first half of 2026. Despite some renewed inflows from the United States following a thaw in political ties, Brazil's record production and competitive prices are simply too much for American exporters to overcome. Brazilian soybeans for March shipment are as much as 75 cents a bushel cheaper than those from the US Gulf. Even with state-owned firms in China fulfilling pledges to buy American crops, private crushers are sticking with Brazil because the tariffs make US beans far more expensive. Brazil's soybean production for the current season is forecast at a staggering record of over 182 million tons. In Russia, however, the agricultural story is more about the weather. Russian wheat export prices have risen for the second week in a row as severe weather at Black Sea ports continues to hold back shipments. Analysts are noting that more than half of the days this month have seen bad weather, which is unheard of compared to the usual 8 or 9 days in January. While the cold is intense, a substantial snow cover is currently protecting the winter crops from damage, though there is concern about what might happen if that snow melts too early in the southern regions. Now, we must talk about the crisis in the American energy sector. A brutal winter storm has absolutely hammered US oil production over the past weekend. At its peak on Saturday, output losses reached 2 million barrels per day, which is roughly 15% of the country's total production. The Permian Basin was hit the hardest, accounting for about 1.5 million barrels of that decline. Major players like ConocoPhillips, Chevron, and ExxonMobil all reported disruptions. Exxon specifically struggled with gas compressors freezing up, which is a major problem because they use that gas compression to lift the oil out of the ground. While production is starting to recover, it is not expected to be fully restored until the end of the month. The storm did not just hit oil, it sent the natural gas market into a frenzy. Front-month gas futures soared nearly 30% on Monday to settle at $6.80 per million British thermal units. On the power side, the grid has been under immense strain. Some 810,000 customers were without power as of Monday. In New England, next-day electricity prices surged over 80%, while prices in parts of Pennsylvania and Maryland skyrocketed by 360% to their highest levels in over a decade. Finally, we look at the freight and raw materials market in West Africa. Guinea's bauxite exports jumped 25% last year to nearly 183 million tonnes. This cements Guinea's position as the world's top exporter of the ore used to make aluminium. China is the primary beneficiary here, taking 74% of those shipments as it tightens its grip on Guinea's vast natural resources. It is a world of extremes right now, from the freezing fields of Texas to the booming harvests in Brazil, and the strategic long games being played in European capitals. As always, the flow of commodities tells the story of our global economy. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and this has been the Commodities Institute podcast.